Michael Yoshikami, how concerned are you that we're overstretched?
A little bit concerned. I think we're in a point right now where we're at the beginning stages of panic buying. And I think investors need to be careful. I don't think it's time to be getting out of stocks. I think that Mike's absolutely right. People were hugely underinvested over the last 3 or 4 months. But we certainly are hearing from people and conversations we have with clients as well as others that they're very, very concerned. They're getting 0% interest. Fed's going to basically keep rates at 0 for, who knows, maybe years. You got dividend rates at 2–3%. Stocks are looking pretty appealing right now, and I think pension funds are feeling exactly the same way and probably adding to the fuel for this market rally.
Barb, you said that you were feeling a little bit nervous about some of the winners, which you've been riding, some of the tech names, and adding a little bit to cyclicals. Give us a recap of what else you're doing and what you're thinking about the market at these highs.
Well, you know, I think what's interesting, the momentum traders in these certain high flyer names have really taken over, and I don't think they're going anywhere soon. There's going to have to be a nasty shock for them all to get killed and stop doing that. And so I think things can go actually a little bit higher in the same names. You know, you see what's happened today, even Netflix. You know, I've been watching that, and that had been lagged, and that's another one that picked up. So these momentum names, I think we have a ways to go. I think that the smart thing would be to start to hedge your bets, which you are starting to see a bit. And that means, you know, as I said, I don't think there's much going in financials. You know, I prefer to play the financials through the MasterCards, the Visas, the PayPals of the world. But, you know, there's always the JPMORGAN, the Citibanks, if you want exposure in the financials, that could respond. Typically, when you start to see the economy get much stronger, which, again, I think is going to be a ways off and not until next year, you can play in those names. You know, you can do it. The housing, Home Depot is a way. I've been long Home Depot for a while because I think that's a nice, safe way because it also has secular characteristics. So in manufacturing, there's any number of names or industrials, you know, whether it's the cats or the deers. You may have to wait a while, you know, but ultimately when the economy picks up, you will make money in those names. And I think right now what's going on is what's the opportunity cost of waiting versus the fear. And that, you know, we have real greed kicking in. And so I think you've just got to be very disciplined and say, okay, these names, I think they can go higher, but it's all momentum and it can end very badly, and start trimming back. You know, you have your positions, the names you think do have great long-term secular characteristics like the Amazons of the world. Stay long, but trim back.
Michael, you disagree. You like the financials?
Well, I think financials are really underbought at this point. I think some of the big banks are going to do well when you actually do have some sort of pickup in economic activity, which, unless there's a surprise about the vaccine news, you're going to see a pickup in economic activity. I think some of the credit card companies certainly hold promise. But again, the big banks, I think, are really underbought at this point. They're still way below where they had been. Many of them pay strong dividends. And, you know, banks are healthier than they were certainly in 2008, 2009. And I think they're going to provide some lubrication to the economy. I think there's going to be motivation from the federal government to get the banks to be active in lending, even though they've tightened lending standards lately. So I think there is some opportunity. One thing I want to say, Will, real quick is investors should not be afraid, even if they have winning positions in their portfolio, to do something that I know that sounds horrible and boring. It's called rebalancing. When something has made a lot of money, it's very, very tempting to let it run. But there's something to be said for actually capturing profit in some of these names and reallocating so you can reduce some of that risk. So when it does end very badly, you're not one of the people that it ends badly for. Something investors, I think, really should think about from a portfolio management standpoint, not just the hot stock perspective.